Right now, as the market gears up for the trading session on this Wednesday, November 19th, 2025, Beyond Meat is hovering in pre-market activity at exactly $1.01, showing a fractional upward tick of about 1% from yesterday's close of an even $1. We are seeing the stock oscillate in a painfully tight range, essentially hugging the psychological $1 floor that separates a tradable asset from a distressed penny stock. The volatility is already showing its teeth before the opening bell, with the price action reflecting a tense standoff between aggressive short sellers betting on a breakdown and contrarian buyers hoping for a bounce from these historic lows. When you see a stock sitting at exactly $1, the immediate expectation is that this is the bottom, the point of maximum pessimism where the only way is up. Investors typically look at a company with a brand name as recognizable as Beyond Meat and assume that at this price point, it represents a deep value play, a bargain ticket on a fallen angel that just needs one piece of good news to double or triple in value. That is the narrative enticing retail traders right now. The belief that the worst is priced in and that the sheer brand equity protects it from going lower. However, the reality is far more complex and significantly more dangerous. The deeper analysis suggests that this low price is not just a reflection of poor sentiment, but a precise mathematical recalculation of the company's diluted equity base, following its recent desperate maneuvers to avoid bankruptcy. While the expectation is that the company has bought itself a runway to turn things around, the reality is that they have exchanged a short-term liquidity crisis for a long-term solvency trap, swapping zero-interest debt for high-interest obligations that will siphon off cash flow for years to come. The market isn't punishing them for the past anymore. It is pricing in a future where equity holders are last in line behind a new wall of secured creditors. This disconnection between the perceived cheapness of the stock and the actual mechanical dilution taking place is what we need to discuss first, because it changes how you interpret every single tick on the chart today. To understand why the stock is pinned at this $1 level, you have to look at the recent capital restructuring. Beyond Meat effectively conducted a distressed debt exchange to deal with their convertible notes that were due in 2027. On paper, this looks like a win because it pushes their debt maturity wall out to 2030, giving them 5 more years to figure things out. But in financial terms, the cost was exorbitant. They exchanged unsecured, zero-interest debt for secured debt carrying a 7% interest rate, and they diluted existing shareholders significantly to sweeten the deal for bondholders. This is why the stock has not rallied despite fixing the balance sheet. The pie has been sliced into so many more pieces that each share currently trading at $1 represents a much smaller claim on the company than a share trading at $1 would have represented 2 years ago. The expectation of a recovery rally is colliding with the reality of massive equity dilution. We need to look closely at the intraday and recent daily movement to see how this is playing out in real time. The stock has been drifting downward, shedding over 30% of its value in just the last month. This isn't just passive selling, it is a coordinated exit by longer-term holders who are finally capitulating after the recent earnings report confirmed that the turnaround is nowhere in sight. The price action we are seeing today, hovering at $1.01, is critical because if the stock breaks below the $1 mark and stays there, it triggers a whole new set of problems, including potential delisting warnings from the exchange. This creates a self-fulfilling prophecy where algorithmic trading systems and institutional risk models automatically dump the stock if it fails to hold this level, creating intense selling pressure that has nothing to do with selling veggie burgers and everything to do with market structure. Speaking of selling pressure, we have to address the elephant in the room, the massive short interest in Beyond Meat. This is one of the most heavily shorted stocks on the entire market, and for good reason. But it also creates a very specific trading dynamic that you need to be aware of. Current data indicates that the short float, the percentage of tradable shares that have been short sold, is hovering around the 37 to 40% range. That is an astronomically high number. In a normal, healthy market, anything above 10% is considered high. When you get to 40%, you are in a battleground. This high short interest is what keeps the borrow rates elevated. If you look at the cost to borrow shares of Beyond Meat right now, it is spiking, which tells us that it's becoming expensive for bears to keep their positions open. This is the only structural hope for the bulls right now, a short squeeze. Because so many people are betting against the stock, any sudden piece of positive news could force those short sellers to buy back shares to cover their positions, triggering a rapid vertical spike in price. But you must be extremely careful with this thesis. Buying a stock solely because you hope for a short squeeze is like picking up pennies in front of a steamroller. The short sellers are not just guessing. They are betting on the fundamental erosion of the business, and so far, they have been right. I want you to take a second and look at the failed to deliver data if you have access to a terminal, or just listen closely. We are seeing elevated failed to delivers in recent cycles, which often happens when short selling becomes crowded and aggressive. This can sometimes signal a temporary bottom or a snapback rally simply because the mechanics of clearing these trades force some buying activity. But do not mistake a mechanical bounce for a fundamental recovery. If you see the stock pop 5 or 10% today or tomorrow, ask yourself if anything has changed in the business, or if you're just watching a dead cat bounce caused by short covering. The borrow fee rates are a metric you should watch like a hawk this week. If the fee to borrow shoots up even higher, it means the supply of shares for shorting is drying up, which often precedes a squeeze. But if the borrow rate stays flat, it means there's plenty of liquidity for bears to keep hammering the stock. Now, let's shift gears to the business performance that is driving the sentiment, specifically the third quarter earnings that dropped earlier this month. The expectation going into the report was that the company's extreme cost-cutting measures would finally lead to better margins, even if sales were soft. The reality was a mixed bag that ultimately disappointed the market. Revenue came in at $70 million, which actually beat the lowered estimates, but the bottom line was a disaster. The net loss widened to over $110 million. Think about that for a moment. They generated $70 million in sales and lost $110 million doing it. A large chunk of that loss was due to non-cash impairment charges, essentially admitting that their assets are worth far less than they previously claimed. But even on an operating basis, the cash burn is alarming. The gross margin, which is the most critical metric for a manufacturing business, collapsed to around 10% from nearly 18% a year ago. This is the number that scares institutional investors the most. If you can't make a healthy profit on the product itself before you even pay for marketing, headquarters, and research, you do not have a viable business model. The compression in margins suggests that they are having to discount their products heavily just to move inventory, which destroys brand power. The demand picture is equally concerning. In the U.S. retail channel, the grocery stores where Beyond Meat originally became a household name, revenue plunged over 18%. This is a continuation of a trend we have seen for quarters now. The novelty has worn off. The early adopters have moved on, and the mass market consumer is not converting at the rate the company predicted. Inflation has played a major role here. When grocery bills are at all-time highs, consumers tend to trade down to cheaper proteins like chicken or conventional beef, rather than paying a premium for a plant-based alternative. Beyond Meat is finding itself squeezed between being a premium product in a budget-conscious economy and a processed food product in a health-conscious market. The health halo that originally surrounded the brand has been tarnished by critics pointing out the long ingredient lists and processing methods. And the company is spending millions trying to fight this narrative with marketing, but the sales data suggests it's not working. Interestingly, the international picture offers a tiny glimmer of hope, which is perhaps the only reason the stock isn't trading at 50 cents today. International food service revenue actually ticked up slightly. This suggests that in markets like Europe, where environmental concerns drive consumer behavior more strongly than in the US, there is still a pulse. However, a 2% gain in international food service cannot offset an 18% drop in the core U.S. retail business. The company is trying to pivot, launching new versions of their burger with healthier oils and cleaner labels, but the retail shelf space is brutal. Once you lose a facing on a shelf in a major retailer, it's incredibly hard to get it back. We're seeing competitors recede as well, which you might think is good